1. Introduction to the all-in-one loan structure. The all-in-one loan is a non-traditional financing instrument that integrates a mortgage with consumer banking functionalities, specifically combining a first-position HELOC with a fully functional checking and savings account. This dynamic framework allows borrowers to leverage income deposits against outstanding principal balances, thereby minimizing interest accrual through daily principal reduction. Unlike conventional amortized mortgages, the all-in-one loan permits uninterrupted liquidity while simultaneously reducing debt obligations. Footnote: the all-in-one loan fuses debt servicing with liquidity management, enabling borrowers to reduce interest through daily income deposits. 2. Interest accrual, closed-ended versus open-ended loans. In conventional mortgages, interest is calculated over a fixed amortization schedule based on an immutable principal and interest allocation set at origination. Payments in the early years disproportionately service interest rather than reduce principal. In contrast, the open-ended all-in-one loan calculates interest daily on the outstanding balance, allowing borrowers to influence the interest burden by depositing income directly into the account. This open-ended structure supports ongoing withdrawals and repayments without the rigidity of closed-ended loan amortization. Footnote: open-ended loans enable real-time interest minimization, whereas closed-ended loans fix borrower liabilities irrespective of income behavior. 3. Accelerated principal reduction through strategic deposits. Each income deposit made into an all-in-one loan account functions equivalently to a principal payment. Borrowers can direct gross rental income, wages, and other revenue streams into the account, reducing the daily balance on which interest accrues. For optimal utilization, borrowers delay expenditures until late in the billing cycle using a credit card for daily expenses, then pay the balance in full just prior to the statement closing date. This allows income to remain against the loan balance longer, significantly reducing monthly interest obligations. Footnote: income deposits serve as interest-saving principal offsets when retained against the loan balance before end-of-cycle disbursement. 4. Liquidity and operational flexibility. Traditional mortgages convert liquidity into a liquid equity, limiting financial flexibility. The all-in-one loan reverses this model by converting equity into usable liquidity. Borrowers maintain 24/7 access to undrawn loan capacity, which may be repurposed for emergency funding, reinvestment, or acquisition. This flexibility enhances risk management and enables seamless reinvestment of idle funds without the need for new loan origination or underwriting approval. Footnote: liquidity retained in the all-in-one loan provides a dynamic reserve for borrower reinvestment or financial contingencies. 5. Safety net and borrower protection provisions. In the event of an income disruption, the all-in-one loan does not impose default penalties unless the outstanding balance approaches the credit limit. Borrowers may temporarily cease deposits without immediate consequence, using available credit to bridge financial hardship. Unlike closed-ended mortgages, this design provides a self-managed safety net that mitigates the risks of missed payments, foreclosure, or credit impairment. Footnote: the all-in-one loan includes intrinsic borrower protections by allowing non-defaulted draws during periods of financial strain. 6. Investment leverage and strategic reuse of funds. The all-in-one loan allows investors to reutilize paid-down equity without incurring new loan fees or delays. Once the balance is reduced, available funds may be reinvested into property acquisitions or capital improvements. This accelerates portfolio growth by turning home equity into a reusable financial instrument, functioning like an accordion for efficient capital deployment without the burden of requalification or closing costs. Footnote: paid-down equity in an all-in-one loan may be redrawn and reinvested, streamlining property acquisition and reinvestment cycles. 7. Automation, digital integration, and financial tools. All-in-one accounts are managed via FDIC-insured institutions and offer familiar banking tools including debit cards, mobile apps, check writing, and online bill pay. These features ensure the user experience parallels conventional banking platforms. Furthermore, automated budgeting and bill management tools help align daily financial behaviors with interest-saving strategies. This preserves ease of use while optimizing financial outcomes. Footnote: the all-in-one platform mimics conventional banking interfaces while empowering strategic interest reduction. 8. Comparative simulation and use case modeling. Borrowers may utilize proprietary simulation tools to compare the all-in-one loan against conventional mortgages. These simulators allow users to forecast savings, loan payoff timelines, and the impact of anticipated draws or deposits. Investors can model real estate acquisition, refinance scenarios, or recurring drawdown strategies for portfolio expansion. Such simulations reinforce informed decision-making and quantify the benefits of adopting the all-in-one strategy. Footnote: forecasting tools quantify the financial advantages of all-in-one loans compared to traditional debt instruments. 9. Qualification criteria and borrower suitability. Qualification for the all-in-one loan is more rigorous than conventional underwriting. Requirements include debt-to-income ratios below 43%, credit scores of 700 plus for owner-occupied and 720 plus for investment properties, and reserve thresholds of 10 to 15% of the line amount. Ideal candidates are financially disciplined borrowers with consistent discretionary income, typically at least 10% of gross monthly deposits, allowing them to extract maximum benefit from the structure. Footnote: the all-in-one loan favors credit-worthy, high-liquidity borrowers who can sustain consistent cash flow. 10. Final considerations and investor call to action. The all-in-one loan is not experimental. It is a globally utilized financial instrument with significant investor utility. By merging liquidity management with mortgage amortization, it empowers borrowers to reduce interest, expand flexibility, and accelerate investment cycles. Prospective borrowers are encouraged to conduct simulations, speak with qualified professionals, and explore Ridge Lending Group's services to determine suitability for their financial objectives. Footnote: investors should initiate simulations and consult qualified lenders to evaluate the all-in-one loan's impact on their financial goals.